Welcome to the InterMarket Analysis video update. Each week, I prepare a video where I look not only at other indexes within the stock market, we also look outside of the stock market. We look at the bond market, we look at commodities, because nothing exists in a vacuum in the financial markets. Sometimes we can get some insight or information about what's happening in the stock market and the S&P 500 by looking at the action of other markets. This is being prepared for Monday, August 28th. Before I get started, please be aware that I am offering a free online course in September. There'll be a 3-hour course that'll be on Monday, September 4th. Please keep in mind that that's also Labor Day. I don't know if that will present a problem. I will be recording this class, so if you find it interesting but you can't attend, you can go back and watch the recording. And then the following week, I'll be offering another 1-hour class spread over 3 days from September 11th through the 13th. I'll be covering my basic philosophy to technical analysis. I'll also be going through some strategies, and I'll be discussing support and resistance. I plan on spending about 1 hour in each area. Also, I plan on streaming it from YouTube and Rumble simultaneously. I've had some issues with that before, so just in case something doesn't go quite right with that, I will have Zoom as a backup that I will be providing the information so we can recongregate in another area if we need to do that. The first area that we look at with InterMarket Analysis is S&P 500 valuation. This is longer term. We don't necessarily make day in, day out decisions with this information, but it just gives us an idea. Is the market overvalued? Is it undervalued? Or is it priced just about right? The first thing that we look at is the trailing 12 months. That's looking backwards. That's not what the stock market does. It looks forward, but we can get some insight by looking back. We have the PE ratio set at different levels. When we take that ratio and it's at 20 or above, the market's considered to be expensive. When we're between 11 and 19, it's considered to be fairly valued. When we're at 10 or below, it's considered inexpensive or cheap. Looking on the chart, the black line is the S&P 500, where we have been coming down recently. The dashed red line is the PE ratio of 20, and we're quite a ways above that, suggesting at the bottom here that we are overvalued on a historical basis. We can also look at that and go back all the way to 1980 and then look at different events that have happened and what the different valuations were at that time. We also look at the Shiller PE ratio developed by Robert Shiller. It takes more of an average to try to smooth things out, especially with earnings. The current reading that we're getting is 30.39. Well, what does that mean? We can look back in time and go, oh my goodness, back in 1929, we're above that level right now. But we also have to understand the context of the current market situation. This can be helped by looking at the median and the mean, where we're at about 1705 for the mean. We're just under 16 with the median. So on a historical basis, we're almost twice as expensive as the historical average for this particular indicator, also suggesting that we are overvalued. But the market looks forward. So they use this based on projections by analysts and forecasts and economic outlook, and they come up with this number that they think the market will be at some future point. We can also do that for individual stocks. Looking at the S&P 500, the S&P forward-looking PE ratio as of the 24th is at 18.5. So we're under that 20 level, but we're above the 15 level. We also look at the mid caps where we're under 15 at 13.6. With the small caps, we're also under 15 at 13.5. So looking forward, the small caps and mid caps are more fairly priced, where the S&P 500, yeah, it's getting a little expensive, but it's still under that 20 level, and that's justifying higher prices. We can combine them into one chart, looking at the S&P 500, which is in red. Then we look at the S&P 400 and the S&P 600 just to get an idea of where we're standing. And these tend to move in tandem with each other. We also look at the small caps, and there are two indexes that we use, the S&P 600 small cap index and that's the blue line. It's coming in at 13.5, so that's more fairly valued. There's another very popular small cap index called the Russell 2000, and it's on a bit of a different scale, and that's the red line, and it's coming in at 22, where we did really spike up. We're coming back down, but you might be able to suggest that we're fairly valued looking forward with this chart. Another area that we look at is growth versus value. Growth is when you want to buy low and sell high. Value is when you want dividends, you want companies that have been around a long time. If we're hitting difficult times in the market, a lot of folks will get out of growth stocks and get into value stocks, and we can get some insight. Because when growth is outperforming value, that's when the market really tends to go higher. When value is outperforming growth, we're usually going either sideways, and quite often we're going down at that point. The first thing that we look at is a peer growth index. And recently we have seen a golden cross with just looking at growth by itself. We also look at a peer value index where it almost came up to a golden cross, but it's seeing some recent weakness, so it's still in an overall downtrend. Where it becomes interesting is when we compare the two with each other. On the top, we have a growth to value ratio showing how growth is outperforming. On the bottom, we have a value to growth ratio showing how value is underperforming. The reason why I do a lot of these inverse charts, and I'll have different charts that seem to be looking at the same thing, is each one of these indexes and a lot of these studies that we plot on here are calculated slightly different. And we want to be able to see the same answers at the same time when we're trying to make decisions. We look at an ETF of growth versus value showing how growth is outperforming. Then we look at the value to growth ETF, which is an inverse of that previous chart, showing how value is underperforming. We look at the peer growth index and compare it with the peer value index, showing how growth is outperforming. Then we look at the inverse of that, showing how value continues to underperform. Then the last chart is we look at another index of growth and compare it with value, showing how growth is outperforming value. Even though the market's hit some difficult times the last week or two, growth is still holding up, especially when you compare it to value. Another way that we look at this is a little bit longer term, using different studies showing how growth is outperforming value, even though it has been seeing some recent weakness. An inverse of that shows how value has underperformed growth, but it is seeing some recent strength. Then we look at the small caps and we take those individually. We look at small cap growth versus small cap value. We've been going sideways to down in the short to intermediate term, but longer term, we still continue to be in an uptrend where growth is outperforming value. We also look at the mid caps, also having a tendency to go sideways, but longer term, growth is outperforming value. This is the important one if you invest in the S&P 500, and the strategies that I do personally are all wrapped around the S&P 500 itself. We're seeing a little bit of improvement when we compare growth to value, but it was not able to break out above this previous high in this ratio. On a short-term basis, we're still kind of in a downtrend. Intermediate term, we're kind of going sideways. Longer term, though, we still remain in an uptrend. We also keep an eye on inflation. This is a monthly chart of the CRB index, where we're above the red line, the moving average. That could suggest that inflation is getting a little bit stronger, as the CRB index has been improving quite a bit. On the bottom, we have a ratio between inflationary areas and deflationary areas, and then we just analyze the two together. When this is going down, that means that inflation is actually decreasing. When compared to deflation, we're dropping below a declining moving average. We also look at the CRB index. This is a daily chart, and we're starting to see a golden cross as this index has been bouncing back up. We also look at the Baltic Dry Index. What does it cost to ship products from point A to point B, specifically in the Baltic region? When this is going down, that just suggests that it's costing less because they're bringing in less revenues, which ultimately turn into less profits. Some other markets that we keep an eye on. Here's aluminum, which continues to be in a downtrend. Corn is also in a downtrend. Wheat, it's bouncing back up, but then it started to drop again. It's in a downtrend. Keep an eye on fertilizer. It had been ticking up, but now it's starting to turn back down. Oil, which got up to the mid 80s, is now dropping below 80 at 79.83. Gas, this is going in an uptrend, and we're in the summer months. A lot of people are doing traveling. We will often see gas prices really going up during this time. We also keep an eye on diesel. It's starting to go back up as well. Trains and big trucks, they use diesel to transport products all around the country. So when this is going up, that means it's costing more for them to deliver these products. Heating oil, it did come down, but now it's starting to go back up, but we're not quite at a golden cross yet. Natural gas is still in an overall downtrend. We look at copper. When copper's doing well, that tends to mean a brighter economic future. When copper's not doing well, that means economic weakness. So that's why they call it Dr. Copper. We have seen a recent death cross with copper on the daily chart, so it is tending to head down. We also compare copper to gold. When copper's going up, we're looking good. When gold's going up, that often means that we're running into some economic difficulties. Then we take a ratio between the two, and it's been chopping more or less sideways in this overall ratio. We take a longer term look at the ratio, where that's the black line where we have been declining. We also plot the 2-year yield in green and the 10-year yield in red. First of all, you'll notice that these are inverted, but there's quite a wide spread between all three of these lines on the chart. And we've seen this for quite a while now, as the economy and the stock market and the bond market are kind of shifting to decide what direction they want to go in. Gold continues to be in an uptrend. It did drop below its 200-day moving average, but now it was able to close back above it. We also look at silver, was able to get back above its 50-period moving average, and is still in an uptrend. We look at gold on the top, just the closing prices, and silver down in the middle, and then we can see at the bottom that there's a really strong correlation between the two. Not a real surprise. Sometimes they get a little out of line with each other, but that just means there's an imbalance in the market, and typically it will work itself out. But this is just a way to actually show graphically, yes, gold and silver tend to have a high correlated relationship. Then we look at the gold to silver ratio on top. And then in the middle section, we look at the US dollar index. And then on the bottom, we have the correlation. And as a general observation, when we see the dollar index going up, gold outperforms silver. And lately, the US dollar index has been bouncing up after it dropped below 100. Then the other side of that is when the dollar index is going down, silver has a tendency to outperform gold. We're not really seeing that all that much right now, as the correlation on the bottom shows that we're pretty much neutral, because the market's a little bit confused right now. Gold is supposed to be the end all for a lot of people, and they just swear by it. There's a little bit of hype that surrounds gold. Everybody gets into it, and then it just kind of sits there, if not declines. Here's the dollar index. As I said earlier, we dropped below 100, but we're starting to make a comeback. On the weekly chart of the dollar, we're actually showing a golden cross because these two moving averages never got that far apart from each other. So this could also provide some headwinds for stocks because the stock market tends to like a weaker dollar. That's good for imports and exports, and it's good for conversion rates, so it looks better on the books. We look at the euro compared to the dollar, where the euro has been declining recently as the dollar's been going up. We also compare it to the Japanese yen on the top, where the yen is underperforming the dollar. Here's a standalone chart comparing the yen to the dollar, showing how the yen is in a downtrend. The British pound is still in an overall uptrend, but we have seen some weakness. It's dropping below its 50-day moving average. Looking at some different indexes, we have the S&P 500, which is a weighted index. So the big mega companies, they have more of an influence on what the S&P does, whether it goes up or down. There's another index that's equal weight, where it takes all of the stocks in the S&P 500 and treats them all the same. That's the red line. When we're going down, it's just showing that the equal weight index, the broader market, is underperforming the S&P 500. We had come back into more of an equilibrium, but since the latter part of July into the early part of August, as the markets develop some weakness, we're seeing the broader market underperforming the bigger stocks. We look at the S&P 500 and compare it to the CRB index and take a ratio where the S&P 500 continues to outperform even though it's dropping below the 50-day moving average. This is an inverse of that same chart, showing how the CRB has been underperforming, but in the short term, it's starting to outperform. We compare the NASDAQ 100 with the S&P 500, and up until the first part of August, they both did really well, but the NASDAQ 100 is continuing to outperform the S&P 500. We look at the S&P 100, which are the biggest stocks in the S&P 500, and compare it to the rest of the S&P, where the bigger stocks continue to outperform. We look at the NASDAQ and compare it to the S&P 500, where the NASDAQ, which is more tech stocks, where the S&P 500 are more established companies that have been around a long time, and we see where the NASDAQ is outperforming, even though we drop below the moving average with this ratio. We compare the NASDAQ 100, which are the biggest stocks on the NASDAQ, and they continue to outperform the rest of the NASDAQ, even though we've been seeing some recent weakness. We look at the mega cap growth, the really big companies, and compare it with the equal weight index, showing how the big companies, the mega caps, they continue to outperform the rest of the S&P 500 equal weight index. We also compare small caps with the S&P. Small caps have really been underperforming. The ratio is this red line. As I always say, in a good solid environment, if we really want to go higher, we want to see this red line going up and actually participating with the other bigger stocks. The blue line here is the S&P 500, where overall on the next chart, we can see that the small caps continue to underperform the rest of the S&P. We look at the biggest software companies, the 30 biggest software companies, where they're still in an uptrend. They came all the way down to their 200-day moving average. We're wondering if we're going to find some support with this index and actually start to bounce back up, or are we going to break further below the 200-day moving average? The really, really big companies, the mega caps, they continue to do quite well. They've been in a solid uptrend, even though we've seen a recent pullback. We look at the robotics and artificial intelligence ETF, where it had been doing quite well, and this is all the rage. It's kind of a new fad as far as the market is concerned, but lately it's been showing some weakness. And where we see even more weakness is when we do a ratio between the AI ETF and compare it to the tech sector. It's really starting to underperform. We look at the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together into one average. It looked like they were breaking out, but now we're seeing some weakness, dropping below the 50-day moving average, but they still are in a longer-term uptrend. We look at the S&P 500 and compare it with shorter-term bond ETFs. The S&P had been outperforming, seeing some weakness, starting to roll over a bit, but we're not getting really concerned, at least yet. Then we look at a broad market measure of using an ETF and compare it with further out bonds, also doing quite well up until the first part of August. Now we're seeing some weakness. Low volatility stocks, which held up quite well in 2022, they're still chopping more or less sideways in 2023. They still remain in an uptrend. We compare the low volatility stocks with the S&P. They outperformed in 2022. They continue to underperform in 2023. We look at the tech sector and compare it with the 3 to 7 year bond ETF. Tech sector had been doing quite well, seeing some recent weakness. We look at the S&P 500 against some other stocks. This is an advanced decline line study, and I'm doing this all take one, so you're going to get my flubs as I'm going through this recording here. We look at the advanced decline line of the NYSE, where we're dropping below the moving average. We're also below the moving average with the S&P, mid caps, and small caps, as the market has hit some difficulties so far in August. We look at traditional Dow theory, where the Dow looked to be breaking out. Now it's coming back down, and it's starting to go below where it had actually broken out. Another area that we keep a close eye on are the transports, where it's still holding out above where we broke out. And we want to see the transports doing well. When the transports are doing well, typically the U.S. economy is doing well, and that helps give some good support to the S&P. We're seeing some real weakness now in utilities, even though they bounced up a little bit in Friday's session. But the fact that the utilities are going down can also give support to the S&P. We take a ratio of the transports to the S&P 500. When this is going up, that means the transports are outperforming. Now, lately, we've been going down as the transports have been underperforming. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming the transports. When this is going down, that means the transports are outperforming. We had been going down, but we're kind of chopping around and going a little bit lower with this ratio. We look at a relationship. Here's the S&P 500, and we look at the transports, and then we see how strong is the relationship between the two. It's trailing off just a little bit, but when we get real high readings like this, that means that they have a tendency to go in the same direction. Then we have a new take on Dow theory, where instead of using the Dow itself, which is 30 stocks, we use the S&P because that's more of a representation of the U.S. economy. And then instead of using the transports, which used to be railroad stocks, we look at the NASDAQ, which is more tech because that's more of a representation of current life. We had been able to break out with the S&P 500, even though we're seeing some weakness. We saw a breakout with the NASDAQ, also some recent weakness, but they're more or less mirroring each other, at least for the current time. The FANG index is having a hard time getting above its 50-day moving average. This is acting as overall resistance right now, even though longer term, the FANG index is still in an uptrend. We were able to break out and set a new all-time high back in July with the FANG index, but since that time, we dropped down below this red line, which was the previous high, and we've been having a lot of trouble ever since then. If we start to go back up, it has some pretty significant overhead resistance. If it starts to fall, of course, that would turn things even more negative. We keep an eye on ARK, which is still seeing a recent golden cross. It started to do quite well, but as other stocks were running into trouble, we're seeing it pulling back to its 200-day moving average. Then we look at the S&P 500 on a monthly chart and compare it with different stocks in Europe, Australia, Asia, and the Far East. We're still above this red line, which is a longer-term moving average, suggesting that we're positive. And when we look at a momentum oscillator below, the PPO, we're still starting to cross above the zero line. So in the bigger picture, the S&P continues to outperform global stocks. We can keep an eye on bonds, where we're starting to see a death cross here with the total bond ETF. The Pring World Bond Index is also seeing a recent death cross here as bond prices have been going down. That means interest rates are going up. But when we look at the stock to bond ratio on a monthly chart, we still show that stocks are outperforming bonds. This also suggests a little shorter term that bonds are underperforming stocks. We look at the high yield corporate bonds, which are junk bonds, and they tend to do quite well. They're in a pretty solid uptrend. Investment grade bonds are chopping down a little bit. We might see a death cross here soon, but we still continue to be in an uptrend. We look at riskier bonds, which typically means junk bonds or companies that are considered to be riskier. Well, in order to entice investors, they offer a higher yield. And we compare that to conservative bonds, which are government bonds. Those are considered to be quite safe. Folks are still liking the idea of riskier bonds. And this would suggest that they still have a favorable outlook going forward, at least economically. We may not really know what's going to happen with interest rates, but at least this crowd is tending to prefer the higher yield of the junk bonds. Even though they take on more risk, they do give you a higher return. We look at a correlation between stocks and bonds where they're having a tendency to go in the same direction, but this relationship is trailing off slightly. We look at the corporate bond index where we've been going sideways for the most part of 2023. We're still in an uptrend. We dropped below the 200-day moving average, but we're having a little bit of a hard time getting back above that moving average. We look at the 10-year yield, which is starting to break out against previous highs. We're coming back down now, but this is causing some concern for the stock market. When interest rates are really breaking out, that's been putting pressure on stocks. Then we look at a long-term view of the 10-year Treasury yield going all the way back to 1980, where if you grew up in the 70s, you had explosive inflation during that time. Well, in the early 80s, things started to turn around and we saw a gradual decline in interest rates where we saw a series of lower highs and lower lows. coming up to the latter part of 2020 or so after the COVID plunge. Well, now we're starting to break out and we're wondering, is the old new normal coming back, or the old normal replacing the new normal? Because typically, if we go up with interest rates, that's historically where they've been at. The anomaly that we're seeing is really over the last 40 years. But folks have become used to that. And most people that are involved in the markets now, this is the only environment they've ever known. So we're keeping an eye on this to see if we are shifting back to a higher interest rate environment. We look at the 30-year yield. We're still above the 61.8% retracement level when we look at our Fibonacci levels. And then we look at the S&P, where it's kind of starting to underperform right here when we look at it compared to the 10-year yield, but it's still in an uptrend. But if we see more weakness with the S&P as interest rates are going back up, we might see a death cross with this ratio. Junk bonds, which continue to hold up quite well and are in an uptrend. We compare junk bonds with government bonds, showing how junk bonds are outperforming. And that's really the way it should be, unless we really start to run into some trouble with the market or economically. That's when people will get out of the riskier bonds and jump back into the safer bonds. We also look at a daily price chart, the bond ETF from 7 to 10 years, where we're going down. With the RSI, we're below 50 and declining. We've seen a recent death cross based on price. We're seeing a little bit of improvement with the MACD, but it hasn't quite crossed over positive, at least yet. We look at a daily chart of yields where they have been going up pretty much across the board here, even though we saw a little bit of a tick down on some of the maturities on Friday. A weekly chart looking internationally with the UK, the rates are coming down a little bit, but they still have the highest rates globally. The green area is the US, where these rates have been going up. And then we have the blue area, which is Germany. The rates continue to go up when you look at them longer term. The red area is Japan. That's a whole different story. They own a lot of US bonds. They're concerned about growth there now, and now that they may have overstimulated their economy, and they've got all these bonds that they were buying that are locked in at lower rates. And if Japan starts to run into trouble, are they going to have to sell those bonds? Which, if those are US bonds, when they sell those, that means price goes down and interest rates go up, and that could influence the US stock market. We look at a long-term view of the 5-year yield where it's still above the moving average, showing that interest rates are going up. But the special K, which is a very long-term momentum oscillator, it continues to decline. We look at the KST, which is not quite as long-term. It shows that the 5-year yield continues to be in an uptrend. We also do another study of the 5-year yield with the short term. It's showing that we're starting to turn back up, but we're still negative. Intermediate term, we continue to be in an uptrend, but long term, we continue to be in a downtrend. Then we look at bonds based on price, looking at the long-term bond ETF. Short term, we're in a downtrend. Intermediate term, we're in a downtrend. Long term, this is suggesting that we're still in an uptrend. Then we look at the MOVE index, which measures the volatility of bonds. And then we compare that with the VIX, which measures the volatility of stocks. And typically they'll have a pretty highly correlated relationship, but we're seeing that trailing off just a little bit as stocks and bonds have been going in opposite directions lately. We look at the price of bonds on a monthly chart and compare it with the CRB index, and then take a ratio where the price of bonds continues to outperform, but we're seeing some recent strength in the CRB index, so this could roll over in the near future. When we look at the price, we're below a declining moving average, showing that the price of bonds continues to go down. We look at different sectors. This is a material sector, and then we compare it with the S&P 500. The materials are underperforming the S&P. Communication is in an uptrend compared to the S&P, and that's where we're seeing a lot of our strength in 2023. We look at the energy sector, which has been in a downtrend compared to the S&P, starting to bounce back up, but seeing some recent weakness. We look at the financials. Remember the banking stories that were coming out? It continues to really underperform the S&P. The industrials also underperforming, but showing some improvement. The tech sector continues to be in an uptrend compared to the S&P. Staples, which did really well in 2022, are underperforming in 2023. Real estate continues to be in a pretty significant downtrend. Utilities also in a downtrend. And then we take a ratio, because when this ratio is going up, that often gives good support to the S&P. This ratio has been going up, and we got a little bit of support from this, but it continues to hold up quite well, but we're not seeing follow through based on price. We look at healthcare, which is more of a defensive investment because you need healthcare no matter what's happening economically, where healthcare continues to underperform the S&P. Here's another chart also showing how healthcare is underperforming. Discretionary continues to be one of the stronger areas in 2023. We've seen some recent weakness, but longer term, we're still in an uptrend. The staples sector, the things that you have to have, still in an uptrend, but has been dropping below its moving averages. The tech sector has been a real area of strength in 2023. We dropped below the 50-period moving average, but we're still in a longer-term uptrend. We look at semiconductors, also in a longer-term uptrend, but seeing some recent weakness. The tech sector compared to the S&P shows how tech has been outperforming, even though they both have been having some difficulties since the beginning of August. We look at energy, which really outperformed in 2022. It's now underperforming in 2023, even though we were seeing a bit of a recent bounce. But now, in the even shorter term, we've been seeing some weakness with energy. Looking at growth to bonds, showing that the growth stocks are outperforming bonds. And then the tech sector, to the rise in interest rates, we're chopping more or less sideways, but the tech sector continues to outperform. This is an inverse of that same chart showing how the rise in interest rates is underperforming the tech sector. Looking at discretionary against staples, showing how discretionary is outperforming. Here's an inverse showing how staples are underperforming. We look at gold, which is still in a longer-term uptrend, but it's really underperforming the S&P. It's also underperforming the rise in the US dollar lately. So gold has been running into some problems, even though it's in a longer-term uptrend. High leverage loans. And as I say every time, if we were getting ready to fall off a cliff economically, would this ratio be going, not this ratio, would this index be going up? Probably not. These are smart people that get into these things, and they have a real feel for what's going on. We would like to see this really go down if we're going to see economic weakness going forward. The fact that this continues to go up does give us some more positive insight economically. We look at the NYSE composite, chopping around quite a bit, but still in an uptrend. Looking at all stocks, not only in the US, but internationally, some recent weakness, but still in an uptrend. Emerging markets, chopping more or less sideways, but still in an uptrend. The micro caps, which are still above 100. Earlier in 2023, we dropped below the 100 level, set a new 52-week low. Since that time, we've been bouncing up, but we're still in a longer-term downtrend. We keep an eye on the home builders. We've been seeing some weakness in the S&P, also in the home builders ETF. The ratio continues to decline and showing that the relationship between the two is quite strong. So it's not really telling us anything. When they get out of line with each other, that's when we really pay attention to this chart. Bitcoin also in a longer-term uptrend, but it's fallen back where it had been able to get up into the 31,000 area. Now it's dropping into the 25,000 area. And then looking internationally, where China is in a downtrend, emerging markets, Europe, Japan, and the US. Everybody is in a longer-term downtrend currently. Looking at InterMarket Analysis, going back to the beginning of 2023, stocks are doing the best, followed by gold, and then the dollar and oil, where bonds have now turned negative since the first part of August. Some correlations, just to get some insight here. We compare the S&P to the dollar. They're having a fairly strong tendency to go in opposite directions. So if the dollar is going up, that's putting pressure on stocks and vice versa. We compare the S&P 500 to oil, where they're having a pretty strong tendency to go in the same direction. We compare the S&P 500 to the 10-year yield, fairly strong tendency to go in opposite directions. We compare the tech sector to the 10-year yield, also not a real strong inverse relationship, but they are going in opposite directions. We compare the S&P 500 to the 2-year yield, where we're dropping back into neutral. Well, we're at minus 0.25 to plus 0.25. I count that as neutral. When we break above, we're going in the same direction. When we break below, we're going in opposite directions. Then some long-term secular, which can mean decades, and cyclical, which can mean years, trend studies. We look at the NYSE composite with a monthly chart, and we're still above the moving average, even though we are declining. The Kopic curve, which is another momentum oscillator, continues to advance and is crossing above zero. Longer term, on a broader market range, we are still looking positive. We also look at a daily chart of the NYSE composite, and then we look at the NYSE record high percent index. It's falling back a little bit here, but it still has been in a longer term uptrend. We look at the S&P and compare it with the PPO on a monthly chart, showing that we're above the moving average, and the PPO, even though it's rolling over a little bit, is still continuing to advance. We compare the S&P 500 with the CRB. The CRBs have been showing some strength, but it's not really showing up in this chart yet. It's just suggesting that the S&P continues to outperform the CRB index. Then we compare another look at the S&P 500 with a global index, with the KST showing that we're going down, but if you look at the chart, we're still above an advancing moving average. So at the very end, I look at what is positive and what is negative. My definition of positive as it applies to this video is when the 50-period simple moving average is above the 200-period simple moving average. We have the growth indexes, which have crossed over with the recent golden cross. The CRB index, that's a new addition to this list. The biggest software companies, the euro and the British pound to the US dollar, even though they're seeing some weakness, longer term, they're outperforming the dollar. Gold and silver are still in uptrends. The mega caps, the low volatility ETF, the composite average for the Dow Jones, the FANG index, as well as ARK, and bonds, the high yield investment grade, corporate bonds, and junk bonds. They're still doing okay. The staples are still in an uptrend, even though they've been chopping sideways. The tech sector and semiconductors in uptrends. High leverage loans, the Dow, the mid caps, and the small caps, the NASDAQ and NASDAQ 100, the NYSE composite, all stocks, emerging markets, and then Bitcoin. All of these are in longer term uptrends. Then we look at what is negative. This is when the 50-period simple moving average drops below the 200-period simple moving average. The value indexes are still in an overall downtrend. Copper, that's a new addition to the list, seeing a recent death cross. The dollar index overall continues to be in a downtrend on the daily chart. We're starting to see a golden cross on the weekly chart. The Japanese yen compared to the US dollar is in a downtrend. This is a new addition. The total bond ETF is showing a new death cross, as well as world bonds. The microcaps are in a shorter term downtrend, even though they're still above that 100 level. Thank you. I hope you found this helpful. I do put out a number of different videos. I do a video each day. I also do a weekly video. There's this video right here. And then after this, I do what I call the deep dive video, where I look at all the different daily charts, and the ones that I didn't talk about all that much, I put them all together and then do another video based on that. So I hope you have a really good weekend, and I will talk to you in the next video.